So I had a really interesting conversation with a friend recently where he quote unquote updated me that he sold out of most of his Alibaba position at roughly $173 per share. And the natural flow of the question was then him asking me, will there be a price that I'll sell Alibaba today? Or am I just going to close my eyes with blind faith, hug the company all the way until the end as a long-term compounder? So I think this was a really, really interesting dynamic that was playing out in my head. We are operating with a lot of assumptions here. Assuming that you are an active investor, managing your own portfolio actively, because if not, the YouTube algo will not recommend my video to you. But let's assume that now you're an active manager, you're actively rebalancing a portfolio, determining whether a company is worth your money, and you determine what's the entry valuation of the stock today to give you a good kind of returns. Surely, there will come a point in time that you'll exit the investment as well. And let's take this conclusion to its extreme. Today, Alibaba is trading at $165 per share. Let's 10x the number. Alibaba trades at $1,600 per share. That's a 200 times price to earnings. Surely, there will come a point in time that you think that, oh, the valuation might feel a little bit egregious. There's too much of the pulling forward of the earnings expectations and things like that. And there will be a price that you sell. Right? So before we go into the numbers itself, I think it's important to also lay down the context of why existing Alibaba investors are tempted or even have the itch to start to take some profits. First things first, of course, on a year-to-date basis, Alibaba has been one of the strongest contender. They've clocked in a triple-digit year-to-date return of over 100%. And not only that, we have Wall Street on the sidelines, pumping in adrenaline, pumping in FOMO. And we have JP Morgan raising their price target by almost 45% to 240 Hong Kong dollars per share. Jefferies raising it by 230, 200, so on and so forth. On one hand, you probably still feel a little bit greedy. You think that it still can go up higher. On the other, you're scared of this renewed optimism of people getting too ahead of themselves in this whole AI craze and want to take some profits off the table. And when we try to aggregate all these different forecasts and price targets around Alibaba today, there are a total of 32 ratings, and 31 out of the 32 is a buy rating. And the next 12-month forecast actually averaged out to be roughly $197 per share, with the highs of 260 and the lows of 120. And you see this range of numbers here between 158 to 220. So depending on how you look at the spread, Alibaba could arguably be fairly valued or still undervalued potentially. So should this then be the framework for you to assess of whether you should hold or sell to the stock? I think I'll discuss it later on. And personally for myself, actually earlier this year, I published a video with the title, My 2025 Target Price for My Portfolio. And please, since you're already at it, don't forget to help me hit the like button of this video. But anyway, at the start of the year, Feb of 2025, I actually had a price target of Alibaba to be $169 on the conservative end and $200 on the optimistic end. I think there's a typo here. It's 2025 intrinsic value. The current price back then was 143 and it showed an upside of roughly 17%, give or take. And as a viewer, I think the intuitive question is, at the start of the year, you laid out a price target of 170. Alibaba has already hit 170. What are you going to do now? So I'll definitely answer that question in the second part of this video, but I think it's also more important to have an updated view of the company today, because based on that video, we were operating with numbers and assumptions from 2024. So I essentially went back to look at my numbers and crunched it again. And of course, I think especially in this whole AI spending era, CapEx is going to skyrocket. People are essentially betting out into the future, and using a discounted cash flow might prove to be a little bit more challenging, because clearly we can't fairly estimate what is the free cash flow profile going to be like. And a lot of the value here will be accorded to the end state where spending actually goes down and free cash flow and the operating income increases a lot and then get discounted to present value. So at least in the next 2 to 3 years, we're going to expect numbers to look really, really ugly because of the direct and indirect spending on AI alone. So for those of you trying to find places to park your extra cash, Weibo has a solid year-end perk for new Singapore users. And this promotion is available from now until the end of the year, 31st December 2025. So first, you pick one of the reward tier. You either keep between $3,000 to $9,999 for 30 days and get 70 Singapore dollars worth of Apple shares, or keep at least 10,000 Singapore dollars for 90 days and you get $280 worth of Apple. Then turn on the 180-day daily interest bonus by getting your daily net deposit to at least 10,000 Singapore dollars within 30 days of your first deposit. From there, you can earn potentially up to 1% or 2.5% per annum on the different tiers of deposits. And if you complete 6 buy trades in that window, you add an additional 1% per annum extra. On days that your balance is below 10,000 Singapore dollars, nothing accrues. So bonuses are paid monthly in Apple shares using this exchange rate and based on Apple's closing price on the day before the 5th. So fees are competitive and Weibo is regulated in Singapore. So if this fits your plan, use the link below to open an account today and lock in that offer. Instead, I think for a lot of all these massive holding companies, there is a different valuation method called sum of the parts. You try to evaluate every single business division and then you add them up together and to kind of put together their so-called fair value or intrinsic value. So to walk you through some of the numbers that I've crunched, looking into Alibaba today, they're currently trading at roughly 165 Hong Kong dollars per share. And that represents roughly 3.2 trillion in Hong Kong dollars. So using their latest March 2025 figure, their financial year end, the Taobao and Tmall, which is the largest division of the business, clocked in an adjusted EBITDA of roughly 200 billion RMB. The international commerce revenue clocked in roughly 132 billion RMB. There's a difference here. EBITDA is earnings before interest, tax, and amortization. On the international commerce arm, because they're not so profitable, that's why we look at revenue. And also for Ali Cloud, we also look at revenue, and they did roughly 118 billion renminbi. And here are my assumptions for the 5-year price target in 2030 for Alibaba. Firstly, on the Taobao Tmall group, I'm expecting them to grow their EBITDA by 6% to 268 billion RMB. For international commerce, I will grow their revenue by 15% and that leads to 265 billion RMB on top line revenue. And for cloud, I'm expecting them to grow their revenue by 20% on a CAGR next 5 years to 293 billion RMB. And the easiest pushback here is, why do you think they'll grow at such a rate and where are you pulling these numbers from? The long and short of it is, of course, it's based on historical and through my ass. But I think jokes aside, clearly, I think you have to have some sort of a basis for a projection. A lot of all these numbers I've actually pulled out through their historical track record based on management guidance and also try to triangulate with some of these Wall Street numbers that they put out in terms of their modeling for some of these companies. So for the EBITDA, I think growing 6 to 8% is the general consensus today. So I use the more conservative number of 6%. For the international commerce top line growth rate, they've actually grew closer to 20 to 30%. So 15% is the more subdued conservative estimate. And for cloud, I think based on Ali's most recent management earnings, they're actually pretty bullish into try to postulate Ali Cloud's growth rate to be closer to over 30% in the next 1 to 2 years. So I tried to kind of balance everything out and assuming that this whole entire AI growth tailwind thesis plays out, growing by 20% year on year for the next 5 years, especially when Ali Cloud is coming from such a small base, I think there is still that bandwidth for growth. And then from there, I applied a valuation multiple of 10 times EBITDA for Taobao, which works out to be 2.68 trillion, 1 time sales on the international business, and 6 times sales for the cloud. And I add all of them up together, and that works out to be roughly 5 trillion Hong Kong dollars. And that equates to 258 Hong Kong dollars per share. So when comparing this 258 at 2030 to 165 Hong Kong dollars today, that represents roughly 9.35% CAGR for 5 years. And of course, after listening through my breakdown of the assumptions here, I will have one of two responses. One camp, which is the bull camp, will think that I'm ultra conservative. These numbers don't even deserve to be published on YouTube because how can you even call yourself a bull? And some of this expansion and growth multiples and growth rates too weak. On the other hand, and the other group, which is on the more bearish camp, would think that, what are you even thinking about? Some of these growth rates are too aggressive. Why do you think they deserve to be trading at 6 times sales or 10 times EBITDA? China, you still have so much of the risk, geopolitical risk of regulation, and things like that. They don't deserve it. Henceforth, I think a lot of all this valuation exercise is both an art and also a science. But at least now, we have some sort of a baseline for us to argue or for us to debate on whether this is a good number or bad number and how do you adjust accordingly. But I think one most common argument for both groups is that most of you, especially for active investors, would think that, oh, this 9.3% CAGR for the next 5 years, holding on to Alibaba, isn't that extremely weak? Shouldn't we at least aim for the moon so that we will land on the stars? We want 12, 15, 20% CAGR expected for investment decisions. Why would you want to hold something at 9% CAGR? And my counter to that is fairly simple. What I'm assuming here, if you haven't forgotten, is that Alibaba is a conglomerate, it's a holding company, it has a lot of business units. And what I've did here is to just evaluate, quote unquote, the three main businesses: Taobao Tmall, international commerce, and cloud. What I've actually forgo completely here is the local services arm, which is the entire quick commerce Ele.me today, which they're spending a lot of money and they're expecting incremental more than 1 trillion GMV to add to the entire business. I've basically wiped that out to zero. For Cainiao, their delivery business also wiped to zero, digital media wiped to zero, and also other parts of the business like Fliggy, DingTalk, Ali Health. Everything here goes to zero. Plus, let's not forget they have a lot of associated and strategic investments in companies like Ant Financials, Weibo, and some of these up and rising AI startups like Moonshot and Zhipu. So everything, all these strategic investments all go to zero because we clearly don't add them up to make these numbers very messy. Plus, let's also not forget that currently Alibaba in the latest quarter reported a 350 billion RMB of net cash position. All those, I also presume that they are used to kind of build out their entire AI data center and all the cloud investments. Everything goes to zero. And just by looking at this framework today, this is my way of expressing some level of conservatism here. And just to give you a flavor in terms of how different analysts make out their price target, this analyst report from DBS had a recommendation of buy and a target price for Alibaba to be 223 Hong Kong dollars per share. And here's their general view. Alibaba is clearly still the leading e-commerce player in China today, the largest, no doubt, although it has lost significant market share to Pinduoduo and other live streaming platforms in China, where their market share actually fell from 52 to 41%. The GMV currently is stabilizing since the beginning of 2024. And today, the cloud and the quick commerce businesses are the key growth engines. So Alibaba leads the China AI cloud market with 36% market share. And the management has also disclosed that they're going to increase their capex expansion on top of their 3-year target. So they forecast the cloud revenue CAGR of 29% during the next 3 years. And that's a much higher number compared to my 20%. And not only that, they are also expecting an incremental $1 trillion in RMB in terms of gross transaction volume for the next 3 years as well in their quick commerce business. Even though we are expecting some sort of an EBITDA loss to at least double from the June quarter. And the customer management revenue growth is also another share price catalyst. And they expect the CMR growth to actually pick up pace to 10% compared to the 6% we've seen just last few quarters. They do have a buy rating with a higher target price of $223 per share. And their sum of the parts methodology here is first, they value their core commerce business at 15 times 2027 price to earnings. And that's $148 Hong Kong dollar per share. And for their cloud business, they value it at 6 times price to sales. And that's 75. So if you add 148 with 75, you get 223. Of course, they highlighted the risk of policy, intense competition, and earnings drag from their investments. So I hope that through this very simple exercise, you can tell where I stand with Alibaba today. I personally don't feel that I'm trying to justify a story of the future, which will need a lot to work in Alibaba's favor in order for the price today to make sense. On the contrary, however, I think there are a lot of potential being littered around them for them to surprise us on the upside, because I'm basically discounting all this potential to zero first. So to answer the opening question of whether there is a price that I'll sell, I think surely there will be one. I think to keep things consistent, the philosophy here is I will buy when it's undervalued and to sell when it's egregiously overvalued. But I believe that it's not at today's pricing. And specifically in terms of the buy and sells, I would sell when I think the thesis change, when it becomes egregiously overvalued, or if I need the money to kind of rebalance. But of course, this sort of rebalancing exercise, you have to look at it on the portfolio level and to kind of measure them out in terms of their relative valuations. So for now, I think the current exposure in Alibaba for my own personal portfolio is not going to move in the foreseeable future at least. Because for one, I don't think it's really crazy overvalued. And for two, I think the downside risk here is quite well managed. So I want to focus on taking care of the downside, and I'll let the upside take care of itself. So in terms of my exposure here, yes, I do have roughly 4,200 9988 shares in the Hong Kong market. I've also been hearing investors comparing the Alibaba of today to pre-2020, before the crackdown, and also because of the revival of the entire cloud and AI trend. I think first things first, I think the circumstances of Alibaba 2019 versus 2025 did undergo some major changes. Especially, I think the magic of Ant Group, there was not a lot of optimism left anymore. And in fact, even the earnings being attributed by Ant Group to Alibaba has also toned down significantly, and they're not as profitable as before. Not forgetting the dominance and competition of the e-commerce landscape has also changed drastically. So on those two fronts, Alibaba's valuations definitely need to take a hit and need to take a discount because things are different already. But on a side note, however, I think firstly, of course, you have the cloud being revitalized. And in fact, it's arguable that it's became even more important on a business fundamental perspective. And it will drive the next stage of growth. So that is kind of the plus point to overtake the whole Ant and e-commerce business. And more importantly, however, an appropriate evaluation will be determined by the rate of growth and the demand runway ahead for AI and cloud, which I think they will definitely lean very heavily into based on management's disclosure recently. And of course, despite the recent rally, I think many investors probably still suffer from PTSD and are very skeptical of the entire China rally. So many valuation models today are still trying to quote-unquote discount a lot of all this China risk, ADR risk, holding companies risk, so on and so forth. For myself, I do think that they're all basically missing the main point here. So the long and short of it is, for myself, there is a sell price or take profit price for Alibaba, but it's definitely not at 165 Hong Kong dollars per share. And with that in mind, I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.